How does US tax residency affect your global income? Imagine living in a country where your earnings from anywhere in the world are part of your tax responsibilities. That's what being a US tax resident means. If you're considered a US tax resident, the government wants to see all the money you make, no matter where it comes from. This includes wages, investments, rental income, or any other earnings outside the United States. You have to report all of it on your US tax return. Now, if you are not a US tax resident, you only need to report income that comes from US sources. For example, if you work for a US company or own property in the US, only that income is taxed by the US government. Income earned abroad from your home country or other nations usually isn't taxed by the US unless it is connected to a US trade or business. US tax residency is mainly decided by two rules. The first is the green card test. If you hold a lawful permanent resident card, often called a green card, at any point during the year, you are considered a US tax resident. This status stays until you give up your green card officially. The second is the substantial presence test. If you are physically in the US for at least 31 days in the current year, and a total of 183 days over the current year and the two previous years, you meet this test. The days are counted with a specific formula. All days in the current year count fully, 1/3 of the days from the previous year, and 1/6 from 2 years ago. There are some exceptions and options for choosing your residency status. For example, you might claim a closer connection to your home country or use a tax treaty to reduce your US tax obligations. These rules are especially important for Asian Americans who travel often or hold dual residency. If you are a US tax resident, you must report all your worldwide income on your US tax return. This can include wages earned abroad, dividends from foreign investments, or rental income from properties outside the US. To avoid double taxation, you might be able to claim foreign tax credits for taxes paid to other countries. Some tax treaties between the US and other nations also offer benefits to reduce your US tax liability. If you are not a US tax resident, you only need to report income from US sources. Knowing your tax residency status helps you stay compliant with US tax laws. It also helps you plan your finances better, especially if you have income or assets outside the US. Consulting with a tax professional familiar with international tax rules can make this process easier. They can help you understand your residency status and guide you on how to report your global income properly.